All right, everybody, we got a busy week coming up. Let's talk about market complacency. Let's talk about the Fed's independence and what to expect and look forward to regarding this upcoming week. We got a lot of moving pieces. So the stock market's rally now hinges on earnings, which it has, with tariffs and Fed drama hopefully background noise. Who knows if that's true or not? By Francis Yu, I believe. So there's this feeling of optimism in the U.S. stock market, mainly around corporate earnings and how this possibly comes in due to tariffs not really coming in and impacting the data too much that we've seen so far. And we got some big players coming out this week, but we got fresh earnings estimates. Despite 3 months of higher tariffs, many analysts anticipate second quarter earnings will exceed expectations, providing a key pillar of support for this market's rally that we're seeing. Of the 53 S&P 500 companies that have reported as of Friday, representing about 11% of this index, 85% have topped analysts' estimates with a median beat of 4%, according to FundStrat. Among the 13% that missed expectations, the median shortfall was only 3%. So the results have also reflected a resilient consumer and healthy business activity. We really got this from the several banks that reported earnings last week and I believe the week prior. So we'll keep on going and seeing what the data shows as it comes out. But as of June 30th, analysts projected S&P 500 earnings to grow 4.9% year over year in the second quarter, according to FactSet. The estimate was revised up to 5.6% as of July 18th. Even so, if earnings land at that level, it would mark the lowest earnings growth for the index since the fourth quarter of 2023, according to FactSet. In 2023, that was a tough year because I remember everybody was worried that we'd go into a recession from the Fed hiking rates and how long we'd stick there. We're still really sticking there. I mean, they've lowered rates a little bit since then, but I mean, it takes a while for the effect of the rate increases, these rate hikes from the Fed to trickle through the economy. And we're like at that point with many more layers stacked on top of that. And we'll get into that. So tariffs, Trump, and Powell. Still, not everyone is convinced the path forward looks smooth, with stocks still vulnerable to tariffs, developments in the artificial industry, and growing concerns about the Federal Reserve's independence. And we'll talk about that a little bit more here in a bit. But with big tech earnings, investors will pay particular attention to the amount of spending on artificial intelligence going forward, just because if anything's going to bail us out and make these companies' valuations make sense, it would be artificial intelligence, because that allows workers to do more with less workers and allows companies to become more efficient, more productive, and save costs, resulting to more at that bottom line. And if the bottom line's looking a little bit more juicy, that pumps up valuations, margins look pretty good, and then possibly valuations fundamentally look good at these stock market highs that we're at. So this week, just to note some, we got Coca-Cola coming out on Tuesday, Google's parent company Alphabet, Tesla, T-Mobile, AT&T. So these are some huge companies. We also got Intel Corp, Blackstone, Deutsche Bank, and NASDAQ Inc. will be reporting on Thursday. So this week regarding earnings, it's going to be a big week. A lot of big old players regarding earnings. And like I said earlier, a lot of people are going to be watching artificial intelligence, signs of a healthy consumer, and the economy holding up, and also tariff impacts. So beyond events in Washington, the market could also be due to some seasonal weakness. August and September are historically the worst performing 2-month periods for U.S. equities. But note, August might have a little bit more support than September, just because August historically is the month of share buybacks for companies repurchasing their stock. So even if there's some type of downtrend, I'd imagine companies are scooping up the deals during it going down, which would provide some type of support. Now let's go into the next article, where 3 reasons why investors have largely ignored Trump's tariff threats as August 1st deadline approaches, by Joseph Adinolfi. And he goes in to talk about, according to the latest reading from the Bank of America Global Fund Market Strategy, risk appetite has risen at its fastest pace on record over the past 3 months. The expectation is that tariffs will be lowered once these negotiations are all said and done, and maybe even the court blocks them. So there's this expectation is that even if Trump were to impose some steep tariffs because the negotiations didn't go well and they didn't settle lower, that the courts will block them, similar to how what we've seen was unveiled on Liberation Day. The levies likely won't hold up in court. So investors are focused on corporate earnings and economic reports. We just talked about that. We got a strong start to the latest quarterly corporate earnings, which has been credited with pushing stocks higher lately. And I'd imagine with the beats will probably consider pushing stocks even up higher, but that's leading into Jamie Dimon's warning and a lot of these other economists and analysts' warnings of market complacency. Investors have also cheered the latest data on employment and retail sales, which has suggested the U.S. economy has taken uncertainty around Trump's trade agenda in stride. So really, Trump's tariffs, according to the market, is a nothing burger. They're either going to settle lower or they're going to be blocked in court and not be as high as they are, because remember, Trump always chickens out, and it'll happen one way or another. But investors are ignoring this market risk is a slow motion wreck waiting to happen. Investors are ignoring it by Reshma Kapadia. Sorry, I didn't say the name right. I'm sure I didn't. And the part that I highlighted out of this is that there are issues that will take a while to play through the economy, a reason for the market's complacency, but analysts are raising flags for investors to not underestimate the growing risks regarding both tariffs and this immigration. Also points to immigration in the U.S., which she doesn't think ICE will be able to hit its goal of 3,000 arrests a day to reach 1 million arrests in a year due to a lack of resources, even after a big boost from the recently passed tax bill. Beamish cautions that the labor market is already structurally tightening. The deterrent effect of the immigration raid shouldn't be underestimated. So there's a little bit on the immigration and then rising tariffs. So those are kind of the concerns that they're discussing in this article. And the economy is being repeatedly pushed into stagflation quadrant, but each shock isn't enough to shift the needle. Hence our boiling the frog metaphor. And if you've never heard of the boiling the frog metaphor, you put this frog in this water in a pot, and then you turn it on low heat, and then like the frog almost paralyzes itself because, we've all been in a bath in a hot tub, like the water just feels so good, and then the frog's just there like mesmerized by how good it feels. And then as the heat keeps on pointing up, the frog's just like so much in comfort that it never like comes to the senses like, oh, I'm being cooked. And then it all hits at once, the frog dies because it's being boiled to death. So that's kind of that analogy. But Beamish forecasts that investors will look back to this period and realize inflation was consistently higher than bond investors were getting paid for, and the economy was tilted more towards stagflation. Eventually, bond investors are going to demand higher yields, and that will translate to lower valuations for stocks. And let's talk about this real quick. When yields go up on bonds, on these treasuries, that has an impact on the economy. Yeah, boring bonds, Joel, we don't care. Well, these bond yields impact borrowing costs on loans. And who gets loans? Well, three major parties. And let's go from the small fries to the big ones. So consumers like you and I, we need loans on like cars, houses, on our credit cards and stuff. So when yields go up, the interest rates on those possibly go up to follow these treasury yields, because the risk appetite of this risk-free yield that you get from these treasuries has gone higher. So how's our loans? Who else borrows money? Well, companies. And there's two main companies that we could mention here. There's big companies with billions of dollars and they're profitable, so it's less risky to lend to them. But think about the riskier contenders who aren't profitable, these smaller companies who really need these loans to keep the lights on, keep paying the bills, and try to keep conducting business. And note, small businesses make up the majority of jobs, so if they're not able to keep the lights on, there's a lot of jobs that are at risk here, so they get affected when the borrowing cost goes up. And just think about that extent. And then the largest fry that borrows money from loans is the federal government. And the U.S. federal government, Trump's always bashing too late Powell for not lowering interest rates because his big, beautiful bill just passed, and that's going to increase the national deficit. The interest expense is going to be much larger for the government, and that's why he wants these yields, this interest rate to be dropped by the Fed so their borrowing costs could go down. Now, whether or not that's the direct impact of that or not, you can argue whether Trump knows or not. Some people argue that the Fed doesn't control longer term yields, it's inflation expectations, and if Trump forces the Fed to cut interest rates, inflation expectations will rise, hence yields increasing as well, making borrowing costs even higher. But let's continue. I digress. So this week, a lot of people are wondering if Trump just surprises, even though he said he's not going to fire Jerome Powell. Some people are thinking, hey, maybe this week or next week or sometime this month or next month, Trump might just pop out and like, hey, too late, you're fired, and cause this shock. But how Besant made the case to Trump against firing Fed Chair Powell by Brian Schwartz and Nick T. The possible effects on the economy and markets, the prospect that the Fed is already moving toward cutting interest rates later this year, and the likely political and legal obstacles that such a move would face are reasons why Besant really wants Trump to avoid firing Jerome Powell on his final 10 months as Fed. Like, hey man, let's wait it out. Here's the reasons behind that. Besant said firing Powell was unnecessary because the economy is doing well and markets have responded positively to the president's policies so far regarding the fiscal policies and tariffs and this big, beautiful bill. So far, like, hey, it's not broke. Let's not try to fix it right now, Trump. Basically, in Besant's words. And that if they did fire Jerome Powell, like, hey, like if everything's going good, why don't we just wait out his term? Because like if we did, we might have to deal with this guy a lot longer, because what if he tried to sue us and this lawsuit might drag into the spring, coinciding with the end of Powell's term anyways. So rather than making this problem a lot worse, let's just stick it out, Trump. Let's not lose our brains here, and let's just keep things moving finally, because we don't know what could happen. But let's talk about what could happen. Firing Powell would shatter the economy's inflation defenses by Greg IP. I've never seen a last name like that. So the U.S. has endured a series of inflationary shocks in the past few years. They mentioned pandemic disruptions, massive fiscal stimulus, Russia's invasion of Ukraine, and immigration clampdown, tariffs, soaring projections of national debt. They didn't even mention the problem in the Middle East between Israel and Iran when everybody thought that oil prices were going to skyrocket. There's a lot more that they left out of this, but for simplicity purposes, those are some of the disruptions that we've had. And then they go on to talk about the real consequences of a Fed would show up gradually once inflation pressures emerge and the Fed, fearful of crossing the president, fails to act because Trump wants us to lower rates, and we're just going to let inflation do its thing because that's what the president wants us to do. So there's that independence in question, and investors and the public would no longer assume low inflation will prevail in the long run. And because expectations are self-fulfilling, inflation itself would grind higher. And it goes back to what we were talking about earlier, where yields increase. And we just talked about how yields impact borrowing costs and could make the economy more restrictive or tightened. So how independence works, whether the Fed is independent isn't up to the next chair. If Trump can fire Powell, he can fire the next person too. So let's say this next person gets into the Fed chair's position and they really try to hold their britches and stand their ground against Trump. That man could also get fired too. So there's this whole box of uncertainty that just opens up from all of this happening. And that plays back into this market's complacency at these all-time highs. And which one was it? One of these articles at the bottom said, it's probably this one right here. Investors may want to start taking some of their bets off of the table and locking in some of the recent highs before inflationary pressures are much more obvious. Remember, we haven't seen much of the tariff impacts in the data yet, although they're beginning to show up and there's hints of them here and there. Overall, it hasn't been like earth-shattering in the data yet. So Yeah, I think that's all I got from Jerome Powell being fired and this inflationary impact. If the Fed were to be replaced early, like if Trump were to fire Jerome Powell, there it just opens up Pandora's box of all of the uncertainties. Like, all right, they're gonna slash rates to zero. How does that impact the U.S. dollar's reserve currency status? How does that impact inflation expectations, which impacts yields and borrowing costs? And how do stock market react to that at these all-time highs? It's just a lot of moving pieces, and whether or not people view the Federal Reserve as an independent of the government or not. And some people argue, hey, it's never really been independent of the government or not. I'd say it still plays a huge role into this because I work in banking right now, and there's still so many people who are sketched about banking because they see the banking industry as being controlled by the government. So just imagine how much worse, like the people hiding the money up in their mattress and a hole in the backyard, what they'd have to say about that and what they're talking about at Thanksgiving, right? But I digress. Let's get into what we got this week. We talked about some of the earnings we got. We got Coca-Cola, AT&T, Tesla, some of the other big O players. What else do we got on the major U.S. economic reports and Fed speakers this week? So we start off on Monday with U.S. leading economic indicators. We're expecting a median forecast of down from the previous forecast to negative 0.2%. Tuesday, we're going to hear from Chair Powell's opening remarks at the banking conference. Wednesday, we got existing home sales. We're expecting that to come in so slightly lower than the previous estimate back in May, so we're getting June's numbers on this. Thursday, we get initial jobless claims for the prior week, so last week's initial jobless claims, and we're expecting this one to come in much higher than, well, I wouldn't say much higher, but just higher than last week. But remember, the data has been looking better as far as the initial jobless claims, so maybe we beat on this and it doesn't come in as, we're expecting it to increase by 8,000 claims. Maybe it comes in lower, or maybe because we've been looking pretty good, maybe this comes in like way worse than expected. And this is the read into the labor market that a lot of people are going to be watching, since we don't get another employment report until after the Fed presents their interest rate decision come, I believe like July 30th or something, the end of the month. We also got S&P Flash U.S. Services PMI, Manufacturing PMI, so Purchase Managers Index. We're expecting services to increase, but we're expecting manufacturing to slightly decrease, and that could probably be the tariffs beginning to show up in the data because some people front ran the tariffs as far as buying, loading up their inventory of goods to front run the tariffs in June and May and June. So July, it's slightly less need to restock inventories. And even if that's not the case, a lot of people just want to sit tight and wait to see what happens. New home sales, we're expecting new home sales to really bump up for the month of June. And you got to think about this with real estate. Real estate's a cyclical industry where the summer will be like real hot. It's real analogous to the seasons in life. So summer's real hot and moving, and a lot of people are outside doing stuff. And then you go into fall, activity starts slowing down. And then in winter, it's like frozen, it's freezing outside. So a lot of people are inside. They're not like out doing stuff. So usually in real estate, winter is much slower or frozen in comparison, and summer's more hot and there's a lot more activity. So even think about like atoms. When they're hot, they're like bouncing all over the place, and then when they're cold, they're like much slower. So the real estate industry is very comparable to that. So then for Friday, we got durable goods orders and durable goods minus transportation, which transportation makes up a lot of costs. So it gives us a read, and we're expecting that to drop quite a bit. So from 16.4% in May to down 11% in June. So we'll keep on watching what happens, y'all. I'm likely going to present all this because Monday through Friday, for the most part, I try to come through and talk about all of what's news in the economic news, what's going on with the stock market, what the Fed said, what's going on with Trump. Because at the end of the day, all of this stuff matters to us who want to look through the eyes of an investor and learn and grow as investors and people who wants to grow our wealth and become more fluent in what's going on. So everybody, I welcome you to join back with me so we can continue learning together, and I'll see you next time when I got something else for us to learn about and talk about. So I'll see you then.